Durante los próximos minutos tenemos además la suerte de poder charlar con Jay Keppel, Senior Research Analyst at sentimenttrader.com. Jay Keppel, Jay, good evening, how are you?
I'm doing well, how about you?
Not bad.
Okay, that's good.
Not bad, yeah. It's the way. It's that the way. We'll look at the markets tonight with your own graphics with this sentiment trader. For this first graphic, you got the 200-day moving average. It's just a favorable note to the trend. Is your friend? Is now the time to apply this maximum?
Well, you know, the old adage is the trend is your friend, and the other one that I like is knowing the trend right now is worth more than 1,000 predictions of what's going to come next. And so this chart, I like to show it fairly often. It shows 4 of the major U.S. indexes, and what we see is that each one of them right now is above their 200-day moving average, and those 200-day moving averages are also rising. So that is basically the textbook definition of a bull market. So right now, you know, we can debate, people can raise all kinds of questions about what's going to happen next. But for a long-term investor, the question is, what is the trend right now? And as long as these 4 indexes remain above those rising 200-day moving averages, we're in an uptrend.
Even with the position of the Fed against the market, the market's had his own way, if we see this kind of graphics.
Well, you know, the Fed is a separate issue, and they're going to do what they're going to do. We'll talk about the bond market in a minute, and they're talking about raising rates, and that can, of course, be a headwind for the stock market. But again, the point of that first chart is just as long as those things are in an uptrend, long-term investors should sit tight.
This is for your first graph, but in the second, we can see a risk-on, risk-off type indicator, risk-on, risk-off, indicator that measures performance of high volatility stocks relative to low volatility stocks, recently flashes as favorable risk-on signal. Is that we see now?
Right. So what this measures, as you said, it's a risk-on, risk-off indicator, and basically looking at the performance of very volatile stocks compared to the performance of very low volatility stocks. And what typically happens in a bear market, people start dumping those high volatility stocks because they're losing too much money too quickly, and they get into low volatility, perceived safety of low volatility stocks. And then what happens is at some point that ratio goes to such a low level that everybody has sold out, and when it turns up, and if you look at the red dots, you can see it doesn't pick bottoms in the market, but it does a very good job of confirming new trends, new uptrends in the market. And if you look at the win rates at the bottom, those are very high numbers. As always, past performance is no guarantee, so we can't say for sure that the market's going to be up a year from now, but this is a very bullish sign that we noticed recently, that it basically means you have to have aggressive buyers in the market. You have to have people in mass being risk on in order to sustain a bull market. And this says that that's what's happening.
Do you think this is going to change in the next months, especially with the volatility index?
I can't really predict that. I'm basically just follow the indicators. My guess is it's going to continue to rise. I think sentiment is a function of price. The more the market goes up, the more bullish people become, the more they want to be in stocks that are going to make the most money. But again, we're just going to have to wait and see.
We could see the inverse volume indicator track. What it is, what do you see at that graphics?
Okay, so the third chart about the bond market is in a kind of a tricky place right now. On a short-term basis, the long-term U.S. Treasury bond is in a very narrow trading range right now, very compressed, and at some point it will break out. And I can't predict which way that's going to go, but for short-term traders, it's real important, I think, to be paying close attention to see which way that breaks out and then jump on whether it's long or short. But for longer-term investors, I'm still a little wary of investing heavily in the bond market right now for two reasons. Number one, here in the U.S., the Fed chairman just the other day said he expects higher interest rates. That's usually a clue that that's what we're going to get. And of course, higher interest rates are bad, especially for long-term bonds. And then in this chart, the index at the top is a proprietary index, but it's very simple. It's just basically a group of indexes and securities that tend to trade inversely to the long-term U.S. Treasury bond. So when that's in an uptrend, as it is right now, and I define that very simply as the 5-week average is above the 30-week average, that's an uptrend. And when that's the case, that is bearish for bonds. And you can see the last signal was over a year and a half ago, or about a year and a half ago in January, and the bond market got hit very hard. And that index at the top, the problem for me is that has shown no signs of reversing to the downside, which would be bullish for bonds. So at this point, I would not be piling into the long-term Treasury as a long-term investment.
Okay, we'll see that and we copy that. For the last chart, this fourth chart, what does the inverse US dollar indicator track? Why is this indicator currently bearish for the dollar?
Right, so this is the same kind of thing. The index at the top is based on indexes and securities that tend to trade inversely to the US dollar. So again, when that's rising, typically we say that's bearish for the dollar. Now, why this is important right now is it's trying to cross over. Last year, the bear market that we saw in the stock market, I think, was based on two things primarily. Number one, of course, was soaring inflation, which causes great doubt and uncertainty. And the other was the soaring US dollar. And then when we saw inflation peak and the dollar peak late last year, all of a sudden, surprise, surprise, the stock market turned around and it's been doing very well. So if the index at the top starts to break down, being bullish for the dollar, that can be a headwind, I think, for the stock market and also for commodities. So if the dollar can continue to decline, that I think will still be good for stocks. And also, although it's probably a topic for another day, and I'm not really in the commodities market right now, if the dollar were to break down hard, I think that would be a good sign for the commodities market that have been down for quite some time.
Jay, looking at the charts, do you think that we have a bearish market until the end of the year, or what do you think about that?
Well, most of the things that I follow have turned net bullish. The indicators that I follow are still net bullish, so still bullish the stock market, and a lot of those things are bullish for a year out. So I'm giving it the benefit of the doubt, but if you go back to that first chart, if things start to break down, then I would reassess.
Okay, bullish, Des. Never stop the bulls now. Jay Keppel, Senior Research Analyst at sentimenttrader.com. Thank you very much from Negocios TV. Thank you to you.
Thank you.
Nosotros vamos a frenar 2 minutitos tras ver ese mercado alcista que dice Jay Keppel va a resistir a lo largo de los próximos meses, especialmente porque no hay un índice de volatilidad que marque que vayan a entrar ni que estén entrando grandes jugadores que puedan derribar el mercado en la parte de esa parte más de los osos, esa tendencia más bajista, y dice Keppel, ojo, miremos hacia arriba porque yo creo que hasta final del año vamos a estar ahí. Vamos a mirar ahora después al mercado.